Hello traders, welcome back to my channel. I'm Alan T. Have you ever found yourself losing money in trading? And one of the biggest reasons is that you placing your orders at the wrong side of the market. But why do traders always enter at the wrong time? The truth is that many traders are unaware of momentum trading. They fail to recognize that the easiest time for you to make money in trading is when you trade alongside with the market momentum. On the other hand, without clear momentum, it becomes very difficult for you to make money, and a lot of traders will suffer in losing streak. And today in this video, I'm going to share how to find the entry point effectively by using the momentum study. So please stick around until the end because I have some insights to share. Alright, let's dive right into it. The market remains in a state of no momentum for extended periods, or more accurately, in a state of momentum accumulations. Traders, when you place trade during this phase, you will suffer in losing streaks most of the time. There are two types of market momentum: momentum accumulations and the momentum distribution phases. Now let's talk about momentum accumulation phase. This is the phase where the market enters a sideways. That also means that the market orders are completely exhausted and it times to rebuild the momentum by accumulating new orders. During this stage, the market volatility becomes irregular and the price prediction becomes unpredictable. And this is when you'll have a lot of losing trades or break-even trades. But why does this happen? Well, when you enter the market during a period of erratic fluctuations and uncertain volatility, the risk of getting caught at the wrong side of the market increases significantly. And that's why you lose, even if your trading direction proves to be accurate. Entering too early without confirmed momentum still means that you are on the wrong side of the market, which prevents you from capitalizing on potential gains. So, to make money in trading, at which stage should we enter? Smart traders like yourself already know you should avoid period without momentum, especially during the period of momentum accumulation phase. Being early in such stage puts you at a disadvantage because you have no idea whether the bullish momentum or the bearish momentum will dominate the market later on. Entering during this time gives you absolutely zero advantage because you don't know how long the price is going to stock in this accumulation phase. Now, if you get in too early during the accumulation phase, you will suffer the agonizing torturing of seeing the price floating, fluctuating between your entry and stop loss levels, which eventually leads to emotional trading. And therefore, we should exercise patience and wait for confirmed momentum to appear. By making right decisions in alignment with momentum, we can significantly increase our success rate. At this point, you may wonder, well, if we wait for momentum to appear, then it means that we enter too late. We as traders, we always want to buy low and sell high. However, you must remember that there is no way we can know that the market has reached its lowest point, or if the price will go lower than the current lows, or the price has reached the highest point and it can go higher than the current high. So why does waiting the momentum to appear substantially improve our success rate? Waiting for the momentum to appear before entering allows us to identify who controls the market. Now, trading with momentums provides us with the greatest potential return and the lowest risk. So how do we identify the momentum distribution phase in the market and execute our trade? In this video, I'll teach you 3 tactics that you can use on the M15 chart to help you to identify and confirm the momentum distribution phase and find high quality entry opportunities. Tactic number 1, specific chart patterns. So there are 3 specific chart patterns that we need to know when it comes to momentum study. Number 1 is the head and shoulder patterns. Now, when we see a head and shoulder patterns, what we need to do is we need to mark the neckline, and then we want a strong momentum candle to break the neckline. So when we have the strong momentum candle to break the neckline, this is where we can confirm there is a momentum shift going on. Momentum distribution has started. Alright, the left shoulder, the head, the right shoulder, the neckline, momentum candle breaks the neckline. This is when we can start to look for entry opportunities, like you can place pending orders, stop loss, and maybe TP 1 to 2 or even 1 to 3 risk rewards ratio. And here you go. This is using the head and shoulder pattern to confirm distributions of the momentum by waiting a strong momentum candle that breaks the neckline. The second pattern that's important in momentum study, which is the triangle pattern. Now, when you saw a triangle pattern, it's there is a resistance, and then you see the price keep on testing the resistance zones. But with each test, the lows are getting higher and higher. Okay, and this forms a triangle pattern. There's a low here, a low here, a low here. So if you connect everything, you will see that it is a triangle pattern. Now, this is what we call triangle tops. And when we have a triangle tops happen, and there is a strong candle close above the zone, that's when we can start to place our buy order, or we can look for buy opportunity. So in this case, I may place my buy opportunity right here. Stop loss maybe somewhere around here. TP 1 to 3 or 1 to 2, whichever is more comfortable, and the price will hit my TP. And the last pattern, which is one of my favorite pattern for momentum study, which is the rectangular patterns. Now, after a massive drop, and then you start to see the price started to make the corrections, but they are on a very small candles, very low momentum candles, and this is what we want to see. And when we have the breakout of the zones, that's when we can place our orders. And TP, again, 1 to 2 or 1 to 3. Now, pay attention that this pause would have to be at least 8 hours long. Anything shorter than that, for me, is very weak. But if it's 8 hours long, then it's a good pause, and it has to happen after one impulsive drop to the downside. Once strong momentum distribution happens, there's an 8 hours pause and there's a breakout. That will be a next momentum distributions that we want to see. Tactic number 2, the Fibonacci retracement tactics. Now, Fibonacci retracement tactics is a very powerful tool that we use after there's a confirmed momentum distributions that push into one direction. And when you started to see the price start to make retracement, that's when you pull out your Fibonacci tool from the low to the high of that impulsive move, and then wait until there's a continuation candle which follows the direction of the momentum distributions pattern, and then you can place your orders, and your TP will follow the Fib level. If 382, we will aim our TP at 1618, and we just wait and see whether the price will hit the TP. Now let's see what happened. Now you can expect a pause of consolidations, because usually after impulsive move, the price will go into a phase of momentum accumulation again. But it will be safer, because if the price still in directions with the previous momentum, then the price will go to the TP. So in this case, our TP is at 1618. So let's see what will the price do. So there's a pause, and the price just fluctuating around, which is normal. And we just wait, and let's see whether the price will hit our TP. Boom. All right. So this is how we trade the Fibonacci tactic. The secret here is we wait after the pause, after the momentum distributions happen, then we place our order. And the last tactic, tactic number 3, the price breaking or rejecting the 100-day moving average. So what else do we need to know about momentum trading? We need to wait until there is a momentum candle close as an entry trigger. It has to be a strong momentum candle, because this is a momentum study. So entry trigger would also need to be strong momentum candle. Number 2, you're going to learn to see the momentum exhaustions pattern. So when you see the candle gets over time, smaller and smaller, or the price started to pause and making a new low that's higher than the previous low, where your initial direction is to sell, which right now is telling you that the momentum is exhausting, and chances are the price will go from bearish to a sideways and maybe to bullish or further drop later on. So when we start to see the momentum is getting exhausted and there is an accumulation pattern coming in, that's when we have to get out. So be able to identify the momentum exhaustions pattern is a skill that you need to master as well if you want to use the momentum study tactic. Now, what you need to do now is train your eyes to be able to spot all these patterns effectively and accurately. But how to do that? Now, take at least 100 screenshots based on the tactics. It will help you to train your eyes to identify all these patterns effectively and fast. And that's all for now. If you like this channel and you think it's helpful, remember to like this video, subscribe, and turn on the notification bell so that you get the latest updates. Until next time, take care. Goodbye.